I'd like to start the program by giving you a quick view on the global markets. I'd like to show you guys just a bit of perspective. Now, this map shows you real GDP growth of the world and the stark difference between Asia and the traditional sources of growth, which is the developed markets. As you can see here in this chart, the greener the color, the higher the growth. And growth is indeed concentrated in Asia. More specifically, our part of Asia. The Philippines, China, and India will be growing between 6 and 10%, while the rest of the Asian periphery, you have Thailand, Indonesia, and Malaysia, will be growing around 3 to 6%. And the fact is, this area is expected to stay green for as long as the World Bank and IMF care to make forecasts, right? Our foreign market experts call it the Asian century, okay? With ASEAN 5 and the Philippines included, we will continue to dictate a larger portion of growth moving forward. To further appreciate, I'd like to show you a chart of GDP. Real GDP growth as forecasted from 2018 all the way to 2023. And emerging and developing Asia will be growing faster than the world. It will be growing twice as fast as developed economies and growing even more aggressive than the rest of the emerging markets, namely Latin America and Africa. And our specific region, ASEAN 5, where we belong, will be growing between 5.5% to 6% over the next 5 years. Inflation, which oftentimes is referred to as the undesirable consequence of growth, diba? As we grow, people tend to bid up prices, will remain to be manageable, at least in our part of the world. Like most of you, I hope going through these slides will help support the thesis that growth is really here. And growth is going to stay here for the foreseeable future. But I'm almost certain that all of you are wondering, if the growth is that high, then what happened from 9,000 to even before the actual recovery started to take hold? We lost around 22% in the market, right? And the answer is very simple. It's about net foreign outflows. Here's an estimate of the outflows from 2010 until, I think, the fourth quarter of 2017. There's an estimate by the IMF of the total inflows we've had in emerging markets. You can see there the whopping $366 billion worth of volumes that flowed into our market. And majority of this is from the expansion of the balance sheet of the Fed, meaning as they eased their markets, money flowed into emerging markets, including us. Again, if growth is going to stay here in Asia, then why are they coming back? Diba? And the answer is also quite simple, because the US is growing faster for longer. The chart on the left shows you that the average US economic expansion is only at 60 months. Now it's at 83 months and counting. Thanks, of course, to the aggressive policies of Mr. Trump in boosting their economic output through tax reform. And it's really not hard to imagine when equity investors that used to be in Asia is now considering coming back to the US. Okay na yung economy eh. So I guess I'll go back there. The chart to the right shows you that the US unemployment rate in blue, there, and the Fed funds rate in orange. The unemployment rate in the US is now at its lowest level, at least as far as this chart is concerned. And they are trying to normalize the rates so they will have another tool to address another crisis, another slowdown or recession. So US is going to increase the rates in the foreseeable future. To make matters worse, the rate normalization of the Fed cannot easily be matched by the central banks of the world, including ours. Because again, iba-iba ho tayo ng growth paths. Iba-iba ng policy recommendations on central banks. So this synchrony will again create the flows that we've seen. And this slide shows you the estimate of the IMF, at least for emerging markets, of the expected outflows in emerging markets, mainly caused by the adjustments in policies by the Fed. And until this forecast is completed in 2019, it's almost a fifth of total outflows. So that's the environment that we're going to live from now moving forward. Time and again, this is another example, ladies and gentlemen, of an external factor affecting our local markets. And we hope that the discussions today will allow us to first look at the data. It's not be carried away with emotions, and using history as our best guide in order for us to make the appropriate strategy moving forward. Ladies and gentlemen, without further ado, let me introduce our distinguished panel for today. First, we have our Vice President and Chief Equity Strategist, Ms. April Tan. And we'll also be joined by our Chief Technical Analyst, Mr. Juanes Barredo. So, let's first talk about what happened. So, I guess I have a question for you, April. So the last time we had an outlook, the market was indeed above or almost breaching the 9,000 level. But when the market corrected back at least around a month ago, close to the 6,900 level, what happened, April?
Hello. Okay. So for the year-to-date period, I think we're 11% down. Yes. But from the peak, we're down 16%. And I think at one point in time, we were at the bear market territory. People were wondering whether we would actually have a bear market. And to a certain extent, we weren't really surprised. Because when we did our market outlook briefing earlier this year, we talked about the risks. And one of the risks that we highlighted was higher than expected inflation due to the implementation of the tax reform program. And of course, you're implementing it at a time when your economic growth is very strong. And secondly, oil prices globally were very high. So as you can see, our inflation rate has gone up quite a bit at 5.3% for the headline inflation. And core inflation, which is actually inflation excluding the volatile prices of oil and food products like rice, still up by 4.3%. So it just goes to show you that inflation really is a problem. And I think another problem is that when we were at 9,100, a lot of stocks were trading at lofty valuations, or fair, I would say, because, for example, when we started the year, we were saying our target for the PSEI was 9,300, and the PSEI was at 9.1. So it only leaves you with a little upside for a lot of stocks. So, of course, when the negative surprise came in, then you had share prices going down. But aside from that, we had other factors that came about that we weren't expecting but were equally bad, When inflation first disappointed or surprised people, the BSP did not move right away. It took them a bit of time because they're saying this is a one-time thing because of the tax reform. So, let's wait until we see the second round effects. So it took them a while before they raised interest rates. And emerging market equities became out of favor. Later, we'll talk about this in more detail kasi mahaba-habang usapan to.
And I guess I just have a quick follow-up, April, with regard to your core and headline inflation. Ano bang basic difference ng dalawa na yun? I mean, for people who are not...
Okay, So as I've said before, the core inflation excludes the impact of oil and rice. Kasi one of the things you can say is the reason why inflation is high is because oil prices are high. So yung core inflation, if I were, for example, the central bank and I look at it, it's more representative of whether there really is pressure in the economy. And, ano pa itong second round effect na pinag-uusapan nila? Kasi kung ako si BSP and I look at inflation, it's not conclusive that there is the second round effect. When I say second round effect, for example, you as a businessman, you're encountered with higher cost. If you feel like the market is very strong and your customers can actually afford to pay more, papaso on nyo yung higher cost. In fact, think about it. Ako, di ba, sabi ko nga every week I buy my Gatorade and what have you. So, I used to pay 19.50 per bottle of Gatorade. Okay? Because of the excise tax on sugary drinks, supposed to be, it's an additional 6 peso per liter. And one bottle of Gatorade is, di ba, 19. So, 500 ml. So, dapat plus 3. Dapat maging 23, 24. But instead of increasing price by only 3 pesos to do a full pass on lang of the excise tax, what these companies did was they doubled the price to 40, 50 pesos. So isn't that reflective na feeling nila, kaya naman ng market i-absorb yan di pass on namin lahat, dagdagan pa namin kasi since mababawasan ng volume, we want our margins to go up. So, you know, that's just how it is. People feel like, well, the demand is strong, so we can pass on the higher price. Kaya pag nabasa niyo yung, di ba si DOF, they consider this to be profiteering, sabi nila. Yan yung sinasabi lang profiteering. That's the second round effect. Because people will always say, oh, we're increasing prices because of tax reform. Pero sa totoo, hindi yun. Hindi totoo yun. They're just using it as an excuse to increase prices of everything. So that's the second round effect that we're talking about, that we're seeing today. And you know, the market doesn't like it because of course it means higher interest rates. I think Juanes will talk about it later. Yeah, and going back to emerging markets, since the slide is there, you will notice that the movement of the Philippines is same as the emerging markets. But of course, we have underperformed. I think a certain part of our weakness is due to our inflation problem, but not 100%. Another part is also due to the underperformance of emerging markets or them being out of favor.
Again, thanks, April. So moving over to Anis. Again, sir, nice to have you back. How did the market fare, sir, based on your technical perspective?
All right, so I think the first half of the year was really quite a bit of a heavy set correction that we saw. In fact, although I was anticipating a correction to come, it came at a form that was a bit more severe than what I initially expected. And the corrections that we've seen took place quite a bit across the world, but it really impacted quite heavily into the Philippines. And the PSEI, as a result, did fall down to that 716,900 zone. And as April did point out, it was really caused primarily because there were certain things that came inside that was unanticipated, at least in the size. Inflation went up too fast. Rates to try to adjust to that inflation came in too slow, and that's why there was an accelerated move to do it. So how many rates did they have? 2 in a span of less than, 4 months? Right? And that's quite of a shocker because normally people tend, even on an aggressive campaign, 125 basis point rise per quarter is normal. All of a sudden you're getting slamming 2 and you don't know if there's going to be another 2 and more likely possible, maybe, we don't know, depending on how inflation looks. And as a result, the market decided to pull back in defense right away. And it didn't even want to rally. Normally, the rallies from a sharp sell-off are usually big. In this case, the rally was actually very blunt, as I'll show you in a little while. So the index right now, at least since we've seen in the last few days, has managed to make a recovery. But it took a while before that came in. Most of the recoveries we've seen have been very slight. But this is the first wider recovery we've had in a long time, but I guess primarily because valuations came to a relatively decent area. And so I think what's going to happen is your market will rally to resistance first, come back after that, and then prepare a base building effect coming from that particular portion. So in the perspective what you see here, so you have the Philippines on the left, you have the US market in the center, and you have the emerging markets index on the right side. You can see that the US was quite resilient. It didn't really back off like the way the Philippine market did back off. But all three of them backed off to their next support levels, particularly the Philippines into a major support level. And that could also be contributing to affect why the Philippines is generating some lift today. I'm still a little worried about the US. I mean, as I was in the beginning of the year, primarily because we're testing previous highs. We've also came out with not so good earnings with some tech stocks that's beaten up a few tech issues in the last couple of days, and I think that we might feel some pressure also coming, and I'll talk about also that later on. Well, I think we have 1 minute. So just to give you a sense of what happened, so this has been the performance of the market from the beginning of the year up to what we've seen where the Philippine Index hit a low where we went below the 20% zone, as you can see there. The red bar shows you the Philippine decline that went to about, close to about, what was that, 27, I think, or 22%, something in that area. The only 2 countries that came close to us was Hong Kong and China. Hong Kong did about 17% at the worst. China also went to about 20% at the worst end of it. The rest did not go down as deep as the way we are. So really the impact was on our side, right? And so clearly something changed over here, and I guess maybe April can give you a sense of that and how that had taken place. Is there one more there? Yeah, okay. So our result, the Philippine Index did back off all the way to that low closer to the area of 6,900. So, but then it managed to be able to make a recovery. What was nice though is that it did break out of the downtrend line. Although that is a positive sign, later I will explain to you that despite that, this bottoming process takes time, right? So I know you might be getting excited. Wow, we broke out of this. That's it. All worst is over. Yes, possibly, but it doesn't mean that good times are back. All right, so what's going to happen is you have to be prepared for what this thing is going to bring on. Although we've had a nice signal here, it takes time to turn the trend around. And we'll explain to you how we're going to handle that later.
All right. Thank you, Juanes. So I guess just to reiterate what you've mentioned, April and Juanes, no? So I guess the correction mainly was exacerbated by the fact that we had those rate increases by the BSP in an environment where they all were telling us na it's not something that we should worry about, right? But they're surprised that it's actually a bit high. And now before we move on to the next part of the presentation, I think we have a question from one of our participants in Slido. Diba? So can we flash it, please? Ayun. So question. Thank you for the question. Ano? So what would the index price range, what should the index price range of the Philippine Index should we enter after the correction of the market? Should we wait for a higher low? I guess this question should be answered a bit later. Or do you care to just give a teaser?
I'll answer you yes first now, and I'll give you the detail later. But yes, it takes time, like I said. So those are one of the things we want to see, a higher low in the index.
All right, so thanks for asking. Keep those questions flowing. Again, if you have any questions, just put it there, and then you can also vote for the questions that you like. Another question. Where is inflation going with Train 2 and the 2019 midterm elections, at least for us? From Mr. Sinin.
That's actually a difficult question, but well, the good news is, next year, the size of the taxes, the excise taxes that will be imposed is much less compared to this year. And remember, the BSP has already raised rates 2 times. Next year, they're gonna raise it by another, or later this year, they're gonna raise it a little bit more. They were messaging it already, and they said, we're not gonna cut reserve requirements first. So they're going to be more aggressive in controlling inflation. So next year, they're anticipating inflation to go down. We think it is strong. There is a strong possibility that it will be lower next year compared to this year. But I think people are waiting for the headline numbers to actually go down before becoming more optimistic. We'll talk about it later.
Sige. So, all right. So